Welcome to the 2014 State of the Union. Obviously, you've heard from Dawn. For those of you who have been to these events in the past, you'll know that most of our commentary is outward looking. We talk about the global economy, we talk about Washington politics, we talk about demographic trends. This year, we thought we'd mix it up a little bit and take our commentary inward. Let's take a look back and see how we did. When we got together this time last year, we predicted that 2013 would be a year where we saw a return of animal spirits to the marketplace. In fact, investors in 2013, by the end of the year, were downright euphoric. This is a model that Citigroup puts together, gauges market sentiment, and people felt really good coming into the end of the year. And one of the things they do when they feel really good is they buy lots of stocks. And this is an amazing chart because what it says is in 2013, investors bought more stocks than they did at previous highs a la 2000 or a la 2007. And so investors truly did gorge on stocks. All right, let's take a look at our more detailed forecasts and see how we did. Speaking to transparency. So in terms of equities, we expected the markets to hit new highs. They ended 2012 at a level of 1425 on the S&P and crossed 1567, which I think was the previous high, ended the year around 1850. And so indeed, stocks, as you know, hit new highs. We thought that small companies would outperform large companies in a high animal spirits kind of environment. That did occur. We thought that the value style of investing might outperform the growth style of investing. We tend to own both. The reality is they kind of tied by the end of the year. Growth outperformed value by about 1%, and so we have to give ourselves a red X. In terms of domicile, we thought that the more compelling valuations overseas, which, as Brian and I will tell you, still exist today, would ultimately induce investors to move capital offshore. In fact, the domestic markets continued to absolutely pound the international market. So what you're seeing in this chart, the green line is the path of the United States stock market last year, up 32%. The blue line is the path of every other market on the planet, rest of world, and you can see that that line's up about 16%. So if you're a global investor like WNA, you're somewhere in between. The divergence between the US stock markets and the international stock markets was pretty darn remarkable. And if you believe in mean reversion, maybe mean reverting already. All right, so we have to give ourselves an X there, and that one kind of hurt. In terms of U.S. interest rates, we expected long rates to go higher. In fact, the 10-year Treasury bond, if I did the math right, the yield climbed last year 72%, which is unbelievable. So long rates absolutely went higher. In terms of the U.S. dollar, just to put a thumb in the eye of the euro Armageddonists, we predicted that the dollar would decline against the euro in 2013. And in fact, it did. I was a little worried about that one, but it did decline. And the dollar actually declined 5% against the euro. And that just goes to tell you when the investment community is convinced that a calamity will occur, it's probably an opportunity. In terms of bonds, we figured that interest rate sensitive bonds would get crushed as interest rates rose, and that's exactly what happened. And we saw the primary threat to the marketplace, and a threat I think Brian still sees today, that there'd be this surge in investor confidence, which would lead to a surge in economic confidence, which might lead to a surge in velocity, therefore inflation, and call the Fed to act earlier than they would otherwise have to act. And while we were right that that was the primary threat, the Fed really didn't get engaged until partially engaged by the end of the year. So overall, 6 out of 8, not bad. Question is, how's that translate into performance? So as you know, hopefully by now, we have a system, we have a discipline, you gotta be disciplined. 45% of the assets in our equity portfolio are invested in the growth style of investing, think Google. 45% invested in the value style of investing, think Clorox. 10% invested in what we call special situations, and I'll tell you more about that. So let's go through. Our growth managers, remember we're global, so we're splitting the difference between international and domestic. Our growth managers were up 27% last year as a group. Our value managers were up 24.4% as a group. Our special situations manager, Brian bailed me out here, we're up 24%. That should have been 43%. We made a rookie investment mistake last year that cost us 1.5% overall, and I'll tell you more about it and self-flagellate in Q&A if you're interested. Hopefully you're not. The S&P 500 was up 32% last year. Remember, that's a pure domestic market. WNA was up 25.5 gross and a little over 24 net. So overall a good year, but again, the domestic market's dominated. Long-term equity model returns, gross of fees, we've been compounding since the model change in mid-2002 at 9.2%, net of fees 8%, and the gross of fees, S&P 500 total return has done about 7.7, so performance intact.